Hi, in this video, we'll take a look at what happens to the return and the risk when we combine risky assets with risk-free assets within a portfolio. So let's assume that we have a bunch or a combination of different risky assets. We're just going to call them RK. The return of the risky assets will be RK. So it does not matter what's inside of the risky assets, but they're just risky. Okay, and then we have the risk-free assets, and the return of risk-free assets will be RF. So essentially, we still have two different types of assets or two different classes of assets. So if we combine these two assets into one single portfolio, we can still use what we have already learned before to calculate its return and its variance or its risks. So let's do it. So we'll assume that the weight for the risky asset will be WK here, and the weight for the risk-free asset will be WF here. And since we're only having these two different asset classes, so these two added up, WK and WF, will always add up to 1. So this will be implied that WK plus WF would be 1 here. Okay, so what is the return for a portfolio with such allocations of assets? So the return or expected return of the portfolio that holds both risky assets and risk-free assets would be WK multiplied by RK plus WF multiplied by RF, right? And then we'll need to calculate the variance of the return of this portfolio. So we'll still use the same formula that we have encountered before from the two stock situation. Only in this case, we don't have two stocks, but two different types of assets here. But the essence is still the same. So we'll use WK squared and then sigma K squared plus WF squared sigma F squared plus 2 times WK, WF, sigma K, sigma F, and rho KF. Okay, so let's take a look at this thing here. Since RF here is the risk-free assets return, so being risk-free means that this type of asset does not have any variance, or sigma F will always be 0 by default. So look at this term here with sigma F squared, this will be 0. Okay, and consequently this term here, sigma F, would be 0 as well. And of course, the rho KF, which is the correlation coefficient between the risky assets and the risk-free asset, will also be 0 because this thing is risk-free. So there shouldn't be any kind of correlation between anything that is risk-free with anything else. Okay, so we basically have these two terms simplified to 0, and we're left with just WK squared and sigma K squared. Right? So the standard deviation or the risk of such portfolio would simply be sigma P, which is the square root of the variance, WK squared, sigma K squared, and then we're left with WK sigma K here. All right? So intuitively, because we're combining something that is risk-free here, so the risk of the whole portfolio should only be relevant to the risky asset part, and the amount of risk is proportional to how much risky asset you have in such a portfolio. So this will be WK, the weight of the risky assets, multiplied by sigma K, which is the risk of your risky assets here, and it has nothing to do with the risk-free assets return or its risk, which is risk-free, which is 0. Okay, so in the next video we'll continue to rearrange the equations here or the calculations here to see what we can arrive at. I'll see you there.